Hi, how you doing? I'm here today to talk about Chapter 1. And Chapter 1 is our introduction to auditing. Sort of an overview of some key points of auditing. Now, I'm sure you realize that the main point of an audit is to inform the public about the financial statements of the organization that was audited. Now, of course, there's many kinds of audits. There's many kinds of steps that you can take when you're doing an audit. But the whole point of it is you are going to be able to, at the end of the audit, say, yes, those financial statements are correct, or no, there's something wrong with those financial statements. Not all auditors audit financial statements. There are operational auditors, there's compliance auditors, there's attest services that are not really audits. But for purposes of this class, we're getting introduced to auditing. And when we talk about auditing, we're talking about auditing the financial statements of a company. All right, so what would an auditor's report look like? I mean, that's the point, right? We want to get to the finished product, and then I'll show you all throughout the semester how we get to that finished product. So let's just look at an auditor's report right now. The auditor reports get filed with the financial statements for public companies, so it's real easy to look up any public company and look at their financial statements. They're filed with the 10K, and as part of that 10K, they're going to file the auditor's report. So let's find one right now. I'm going to go to sec.gov, so I'm going to look at the SEC's website. And if you've never been to the SEC's website, it's a pretty nice site. You can look up company filings, so anything a company is required to file with the SEC, you can look at it. The SEC, of course, is the organization that takes actions against any public registrants. So if you sell securities, if you're a public company, you will have to have information with the SEC. Enforcement action, so if a CPA did something bad and the SEC charged them, that would be here. So this is the government agency that takes care of the exchanges and keeps things fair and regulates all the securities that get traded, whether it's on an exchange or not on an exchange. So we're going to look up the financial statements for a public company. To do that, I need to go to what's called Edgar. And here's a big old button for Edgar right here. So we'll go to Edgar, and let's look up Facebook. Company name, Facebook. Any company you want to look up that's a public company, right, that people own stock in, you can look up. And here's all the filings. You can see that Facebook has filed an 8K about a month ago. Their 10Q, their quarterlies, the 8K. And so what we want is called a 10K, right? The 10K is the form on which they file their annual financial statements with the SEC. So under filing type, I'm just going to type 10K or 10-K, right? And here's all the 10Ks. Facebook hasn't been a public company for that long. So you can see they've filed 3 10Ks, and this 10K-A, that's an amended, so that's something they filed they later added to, so 10Ka. So let's just look at the financial statements. That's where the auditor's report will be. So here I found the 10K. I'm going to click on it. There you go. Here's Facebook's filing with the SEC, Facebook Inc. And there's a clickable table of contents, and most of the filings have this. So if you ever look up a company, which you will in our class, you should be able to click around. So what I want is always in section 8, right? I want the financial statements. So that's the beauty of looking at these government forms, is they have specific sections with specific information. So once you get used to looking at them, you just go to that section you want. So we want the financial statements for Facebook, so I go to section 8 of the 10K filed with the SEC. You can do this for any company that you want. And you can see report of the registered public accountant. Of course, it's right here. So here's the report. That's it. This little paragraph and this little paragraph. That's all anybody knows about the audit for Facebook. What did they say? Well, I mean, I can look at this and it says report of independent registered public accounting firm. So that tells me an independent, meaning independent of Facebook, right? Not the Facebook's own internal auditors didn't file this. Registered means they're registered with the PCAOB. It's okay for them to do audits of public company. They're registered to do that. Public accounting firm. It's addressed to the board of directors and stockholders because that's really who the financial statements are prepared for, right? The owners of the company and the board who runs the company. This report just simply says we have audited the accompanying balance sheets as of December 31, 2014, and the related statements of income, equity, cash flows. So they're saying this is what we audited, these financial statements. The financial statements are the responsibility of the company's management. Our responsibility is to express an opinion on the financial statements. So right up front they're letting you know, hey, Facebook management, they prepared these financial statements. That's the management's responsibility to keep track of the records at the company and compile them into financial statements. We're just the auditors. We just go in after the fact and express an opinion. Yes, these are good financial statements. No, here's some stuff wrong. So they say, okay, management prepared them. We looked at them. We conducted our audit in accordance with standards of Public Company Accounting Oversight Board. We'll call that PCAOB from now on in class. Right? So they're telling you we followed the rules of doing an audit. The rules we followed were PCAOB rules. Those standards require that we plan and perform to obtain reasonable assurance. So these auditors aren't 100% guaranteeing that these financial statements are perfect. They're saying reasonable assurance. Whether the financial statements are free of material misstatement. So they aren't even saying we provide reasonable assurance they're perfect. We're providing reasonable assurance there's nothing material wrong with them. Yeah, there could be something not material, but we didn't look for anything not material. We didn't look for material stuff. It includes examining on a test basis evidence supporting the amounts and disclosures in the financial. So they went to the company and they got some evidence, right? They looked at documents, they talked to people, they got evidence. And they did it on a test basis. So that means we didn't look at every single thing that ever happened at Facebook all year long. We took some samples and we looked at some of them. All right? And we included assessing the principles and the overall financial statement principles. So we kind of gave an overall, are they using the right accounting stuff? We believe our audit provides a reasonable basis for our opinion. So we think we did a good job. Our opinion's valid. In our opinion, the financial statements present fairly in all material respects the position of Facebook as of a date, for the 3 years ended in conformity with U.S. generally accepted accounting principles. So what they say is there's no material misstatements according to GAAP, right? So we're applying GAAP accounting. We also audited the internal controls over financial reporting, right? So internal controls are what handle the risks of not reporting correctly, right? At least the internal controls over financial reporting are handling those risks of something bad getting in the financial statements. And they're saying they express an unqualified opinion on these. So an unqualified opinion means we're okay with them. Unqualified doesn't mean the auditors are not qualified to give the opinion. It means we don't have any reservations or qualifications about them. We're good with that. All right? And then they go on to give the separate opinion over internal controls over financial reporting. All right? And they say they've tested the controls and we think they're fine. All right? So this is it. Now clearly we were able to go over that auditor's report in a few minutes. So what's the big deal with taking a whole class on it? It's a whole entire section of the CPA exam. What goes on? Well, the point is, in order to come up with this opinion, you have to do these tests. You have to do them in accordance with standards. So in this class, we're going to learn how to do the audit according to standards, so we can have an opinion at the end, right? So we're going to learn what are the risks to the financial statements, how do companies control for that, right? That's what this internal control statement is all about. Companies need to have controls in place to make sure their financial statements are fairly presented, so auditors are going to check those controls. All right, so we understand the risks, we understand the controls. Then we go to the company and we gather evidence, right? Well, we're going to use a lot of different techniques to gather evidence, and of course we're going to learn those. So we're going to learn about risks to the financial statements. We're going to learn about controls for those risks. We're going to learn about gathering evidence to test those controls and to test the account balances. And we're going to learn how to do all this stuff according to audit standards, right? So there's a lot of rules about how you do stuff, and that's what this says here. We did our audit in accordance with the rules. So we're going to learn those rules. So we're going to learn the rules for doing an audit. We're going to learn how to do an audit. We're going to learn how to come up with an opinion. This class is very basic. It's going to be our first shot at learning audit terms, audit theory. So a lot of it will be geared towards learning the terms, learning the theory, learning about audit standards in a way that would enable you to study for the CPA exam. You know, in other words, you'd recognize these terms. You'd know what is meant. You know, when we start talking about, when on the CPA study guide you find management assertion questions, you'll know what that is. You won't be confused. But would I expect you to be able to leave the class and do an audit? No, certainly not, but no employer would either. Your employer would show you, come to this desk, sit here, add up all these numbers on all of these sheets and make sure they match, right? So doing an audit, not the same thing as understanding the idea of an audit, right? So this is the end of the audit. We have given our opinion. It's been filed with the financial statements at the SEC. The rest of the class is going to be about getting to that opinion. All right, so I'm going to show you PowerPoint for Chapter 1. It's very short, but it does follow along with Chapter 1. You might even want to have Chapter 1 out. It may be helpful to look at some exhibits from Chapter 1 as we go. All right, so Chapter 1, Auditing and Assurance Services. So auditing means specifically we're auditing financial statements. Assurance services means we're providing assurance to a third party. So all audits are assurance services, but not all assurance services are audits, right? So assurance means I'm telling you so you can feel assured or safe, right? So if you think about it in terms of a financial statement audit, who needs to know about that company? Well, the people who have financial stake in a company, right? So when we looked at Facebook, right? we saw that the auditors addressed their report to the shareholders, right? So Facebook's a public company, and shareholders are the owners of that company, right? So of course, they're very interested in what goes on at Facebook, and they want to know the finances. Banks are interested, right? So probably Facebook, or even a non-public company. You can imagine a small company, here in Kingsville might go to Clayburg Bank and borrow some money. Well, Clayburg Bank would want to make sure the finances for that company are good. Right? So a way they can feel assured is to hire somebody to go examine the financial statements and tell them, I'm an independent third party, and I've gone and done this examination, and you can count on me and my word. All right? So that's what auditors do. They go to the company, right, like Facebook, they examine them, and they provide their opinion for the rest of the world, right? Because, the managers know how the company's doing. The point is, as shareholders, as bankers, as the public, we don't know if we can trust Facebook management or not, right? Because they certainly would have motives to try to make the financial statements look better than they really are. So in order to be able to trust those financial statements, we have an auditor provide us with assurance. That's all that means. So auditors are providing the assurance for the financial statements. So auditing is a systematic process of objectively obtaining and evaluating evidence regarding assertions, right? So here's the first word that's going to be real important to us all semester long: assertions. The financial statements are assertions made by management when you think about it. And what's the word assertion mean? It just means I'm telling you this, right? So if I'm management of Facebook and I publish financial statements, and I say, here's my balance sheet, my cash balance is $100 million in cash. I'm asserting that we have $100 million in cash, right? So all the financial statements are assertions, all right? And we're going to learn some categories of assertions here in a little while, all right? So we are obtaining evidence about assertions. So who makes them? Management. This is, we're talking financial statements here. So management makes assertions. We get evidence about them. About economic actions and events to ascertain the degree of correspondence between the assertions and establish the criteria. So if Facebook says our revenues for the year were $1 billion, right? Well, as we know, GAAP says revenue's not revenue until we've substantially delivered the service. There's reasonable expectation of payment, right? So if you took out some subscriptions for advertising and Facebook was going to make some revenue this year, some revenue next year, right? Well, they don't get to count next year's revenue in this year, even though maybe it all got paid up front. Right? So that's GAAP. GAAP says there's only certain times you can recognize revenue when you deliver the service. Right? So I, as an auditor, I'm going to say, well, Facebook, you've asserted that you have $1 billion in revenue. I'm going to go check. I'm going to see if that revenue is all really revenue, or if maybe some of it is unearned revenue, right? They paid you, but you haven't delivered the service yet, right? So between their assertion and the criteria, which is GAAP, and communicating the results. So that's that auditor's report, right? That's what we looked at on Facebook. We read their auditor's report. They communicated it. Interested users, right? So that's why we saw that auditor's report was addressed to the financial stakeholders, which were the owners of the company, right? So creditors, investors, right? So auditing is about getting evidence about assertions, which basically are the financial statements, comparing them to GAAP, decide, does that match? Are they fairly presented in accordance with GAAP? And communicating the results. Alright, so here's an overview of financial statement auditing. So this is Exhibit 1.1 from your book. You might want to have your book out as we go through. But this is a pretty good idea of what auditors do and how financial statements come to be, right? So, management makes assertions about actions and events, right? So in other words, management prepares the balance sheet, the income statement, cash flows, and footnotes, right? And these exist. These are their assertions. Management asserts this, right? When they prepare these, they're supposed to prepare them according to a framework. In the United States, we talk about U.S. GAAP, but certainly an international company, Royal Dutch Shell, might use IFRS. All right? So these financial statements are supposed to be prepared in accordance with a framework. All right? Auditors come along, right? We're an objective third party, right? So people can trust us, right? So management is supposed to prepare these financial statements in accordance with GAAP. Do they really? I don't know. Maybe they want to get a bonus, so they inflate the revenues or something. Who knows? So we can't trust management, right? We can't be watching management all the time. So what we do is we hire auditors to come and use audit standards to audit, right? And they're going to do some procedures, and they're going to go examine these financial statements, and they're going to look at the financial statements. They're going to compare them to what is supposed to be, and they'll issue a report that says they're fairly presented or not. So that's it. Management prepares statements, auditors audit them, and compare them to what they're supposed to be, and give a report. That's what auditing is. But it's this box here that we're going to spend most of the time here and maybe one chapter on preparing the audit report. All right. So, just to be clear, auditors audit the financial statements. Management prepares the financial statements. In 2002, Congress passed and the President signed the Sarbanes-Oxley Act. This was a direct result of Enron. If Enron hadn't happened, probably wouldn't have Sarbanes-Oxley. But Sarbanes-Oxley is full of a lot of good ideas that pertain to corporate governance and making management do right. So one of the things they decided was management is responsible for doing the financial statements. And one of the issues with some of these companies that went over back around 2001 was these CEOs and CFOs say, oh, I didn't really cheat on those financial statements. I didn't know what they said. I didn't even read them. So now, Sarbanes-Oxley says the CEO and CFO have to read them. They have to state that they've read them. They have to state they're not aware of anything misleading, and they believe it presents an accurate picture of the company. So they're kind of holding the CEO and CFO now, public companies, hold that CEO and CFO responsible for the financial statements. They're responsible for preparing them, right? So this belongs to management. Management prepares the financial statements. Auditors just audit them. All right. So that's why you actually saw in that auditor's report, the auditors say, management's responsibility is the statements. We're responsible for an opinion. Now, when management prepares their financial statements, they are making assertions about the company, right? So it's pretty easy to imagine. You look at financial statements, you could say a balance sheet. Well, on the left you've got assets, on the right you've got liabilities and owner's equity. And every one of those lines says something about the company, right? The management is saying, when it says cash in a certain balance, here's how much cash we have. When it says accounts receivable, here's the balance of our accounts receivable accounts, right? So you can see how those are assertions. Management is asserting something about a balance. However, that's not all they're asserting, really, when you think about it, because there are some dimensions that go into making that balance the account balance, right? for example, that cash exists, right? Or that sale occurred. You have the rights to that machine. You actually own that machine. If you're putting that machine on your balance sheet as a fixed asset, you actually own that. It's not a machine you've rented, right? So you have the right to that. Complete. You haven't left anything out, right? I mean, wouldn't it be nice to say, oh, we have 1 million in liabilities, when really you had 10 million in liabilities, right? You're saying everything's complete. It's there. Valuation or allocation. That balance is correct, right? If I look at inventory, like I'm a manufacturing firm, and my inventory is based on my raw materials costs, my overhead costs, and my labor costs, right? And I've allocated those, and that number is based on actual appropriate GAAP numbers, right? And presentation and disclosure. Everything's presented, it's in the right place, right? So there are certain additional assertions being made with every financial statement that are just sort of hidden or embedded within them, right? I mean, it kind of goes without saying, right? That, well, if I look at the balance sheet and I see land, $10 million, well, yes, of course that land exists. There's a piece of land somewhere that it's worth $10 million, or historical cost. They paid $10 million for it. That I have the rights to that land. That it's actually mine in my name, right? So, but they can't go without saying. As an auditor, I have to test all that stuff, right? I mean, I can't just go, oh yeah, there's a piece of land worth $10 million. Well, does it actually belong to that person? I have to test all this stuff. So it's important in auditing that the first thing we start to recognize is these assertions. All right? Now, we haven't gotten to chapter 2 where we talk about audit standards, but I want you to take note here that this list of standards comes from the PCAOB, the Public Company Accounting Oversight Board, PCAOB, and they are the people, the entity that creates the standards for auditing public companies. Right? Not every company is a public company. So that's another thing we have to think about when we think about standards. So Facebook, we just looked up, they had an SEC filing, that's a public company. But some companies are not public. You can't go on a stock exchange and buy their shares, like HEB. HEB is not a public company. Therefore, their standards come from the ASB, the Audit Standards Board. So we'll learn more about these two entities, but I just want to make sure you understand auditing public companies and auditing private companies have two different sets of standards. But you're still going to audit them according to standards, and you're still going to audit all of what management is asserting. So how do these assertions come into play? Well, as I do my audit, right, as I sit down and I audit the balance sheet and the income statement, we're not going to talk about cash flows because those arise from the other two. But as I audit, I have to audit according to standards. And PCAOB standards say I have to audit existence or occurrence, rights and obligation, completeness, valuation or allocation, presentation and disclosure, right? So I can't just kind of go, yep, that balance for land is 10 million. I have to make sure it exists, right? It's not about occurrence with land because land is an asset, all right? It's a thing that actually exists. For occurrence would be something that happens, like a sale, right? So if I was testing revenue on the income statement, right? So they say, oh, we have $1 billion in revenue. Well, how do you get revenue? Well, you get revenue from sales. So now I'm not so much checking to see if that revenue exists, I'm checking to see did those sales really occur. So PCAOB says for assets and liabilities, you check their existence. for transactions, you check and see if they actually occurred. So if I paid a liability, did that transaction occur? If I received a sale, did that actually occur? So existence versus occurrence, right? This depends on what kind of account you're testing. Asset or liability, existence. Revenue or expense, occurrence. All right, same thing with rights and obligations. So PCOB says, if I'm auditing a public company, right, because that's what PCOB is for, public companies, I need to check for rights and obligations, right? So if I'm saying I own an asset, I actually own it. It's not leased. If I have inventory, it's my inventory. It's not on consignment, right? I have the right to that. Or obligations, I'm actually responsible to pay that liability or that expense, right? I actually owe that. So this comes into play, especially when an employee is maybe committing fraud, right? And they're charging expenses that aren't really the company's. Well, the company doesn't really have that obligation. So if that obligation that's not the company's gets in the financial statements, they don't have it. So they're asserting they have that obligation, but really they don't. They've overstated it, right? So rights and obligation. If I'm auditing a public company, everything needs to be recorded in the financial statement. So people don't generally understate revenue or understate assets, but understate expenses, understate liabilities, sure, they'd love to do that. So one of the things you have to check for is completeness. Make sure everything got in there. Same thing with valuation or allocation, right? Some things I'd really like to say they're worth more, right? My accounts receivable. If I know somebody's declared bankruptcy and I'm not really going to get that money, I can't leave that receivable, not according to GAAP. So as an auditor, yes, I've checked to see that that account receivable exists. I have the right, the company has the right to the money, all the accounts receivable got in there, but that valuation's wrong because you know what? They filed, that creditor filed for bankruptcy and they're not going to pay us. So that valuation's not right? So that assertion has been tested. And presentation and disclosure. Everything's in an appropriate place, so I'm not accidentally calling an expense an asset, right? I haven't capitalized my expenses. They're in the right account. I've disclosed everything, so if there's some contingent liabilities, right, I've put those in the footnotes, right? So everything's good. So it's not just about that balance number. It's about everything that contributes to that balance. So we're going to get used to talking about this, but you need to understand this idea that when we audit, we're not just looking at that number and seeing if it's the right number. We're looking for all of the assertions. And PCOB says these are the assertions. Now, all right, well, I'm having a little problem. Okay, now, sometimes when we audit private companies. Then, as we'll learn in the next chapter, there's the ASB, and they have some standards. So just like PCAOB says, when you audit for these assertions, ASB does the same thing. So you need to start understanding this idea of assertions. So ASB divides their assertions. So PCAOB just said, here's the assertions, apply them either to an asset, a liability, a revenue, or an expense, apply them as appropriate. What ASB does for private company audits, they say, well, here's the assertions you have to check for events and transactions. So events and transactions would be revenue, expenses, things that happen, right? So you have to check for occurrence, right? Did that sale actually occur, right? Completeness, right? Did all those expenses get on the books, right? Completeness. Cutoff. Is it in the right period, right? So if that expense occurred this month, it's in this month's financial statements. If that revenue occurred last month, it's in last month, right? Cutoff. Completeness and cutoff. Everything got reported and it got in the appropriate period. Accuracy. The transactions. This is at the transaction level, right? transaction level, they're recorded in the correct amount. So things like, if you're looking at an invoice for a sale, right, the number of units is correct, the price is correct, the extension is correct. So 10 units at $100 each, that got multiplied out and is $1,000. That number is correct. They used the right price. They really did sell 10 units. They did the math right. Accuracy. And classification in the proper account, right? So if you had an expense, it's not listed as an asset. If you have an account receivable from Joe, it's not listed in Jane's, right? So these are transactions that occurred, and here's what you need to test. If you're doing an ASB compliant audit for a private company, here's assertions you need to test for events and transactions. If you're testing balances, right, so I'm looking at the balance sheet and I'm testing cash balance, I'm testing inventory balance, right? I'm testing balances. I need to test for existence, right? Balance include only assets and liabilities that exist. Right, so there really is cash there. There really is land there. Rights, you own it, or if it's a liability, you owe it. Have the legal responsibility for it. So if somebody's committing fraud, you might not have the legal responsibility for it. All right, sorry about that. Touch screen. Completeness kind of stands on its own. Accuracy and valuation. Accuracy is based on the numbers are correct, valuation. So numbers are correct, like if I'm doing inventory and I counted 50 units at $50, and I multiplied that and got 2,500 for my number, that I got that $50 is the right number, that there really were 50, and valuation is the balance is the right number. So accuracy is like at an individual number level, I guess I'd call it. Right? Did the number itself get on the page right? Right? Like an invoice, did it get on there right? Valuation is the overall balance. All right, and presentation and disclosure. Right? So that means my disclosures, my overall financial statements, and how I'm presenting it and when it's goes in. Right? Everything is there. Either items are occurred or owned. It's complete. Classification and understandability, you can understand it. Accuracy and valuation. So the same thing, but just for the disclosures, like things you have to disclose, like contingent liabilities. And so here, now this is where I need the touch screen. This is great. Here's kind of an example. So if you look, I think it'd be great if you could look at Exhibit 1.6 in your book, because this is a very good example of the assertions and how they relate to the financial statement. So if I'm an auditor, and I'm going to come audit this Apollo shoes, right? So I'm going to audit this entire set of financial statements. I'm going to audit this balance sheet, or in this case I call it financial condition. Here's the income statement, and here are the disclosures, right? So I have to think about my audit according to standards, and standards say I have to audit for all these assertions. All right. Also, it just keeps me from missing anything. It gives me a very systematic way to think about my audit. For every one of these lines, I'm going to check for existence. I'm going to check for rights. I'm going to check for valuation. Right. So, existence. Does this cash really exist? Right. And so, as an auditor, I'm going to test that. How am I? Probably I'll just get a bank statement. Right. But this is what's going to happen. I'm going to do all of these for all of these accounts. Rights and obligations. So for cash, since it's an asset, you would have a right, right? And here they go, inventory, right? They're pointing at inventory. So if you think about inventory, does it exist? Well, I could go look at it. Yeah, there it is. It's in the warehouse. There's some inventory. It exists. But do we really own it? You know, I've been in several H-E-B warehouses, and a lot of that stuff they don't own. Like the Cokes they don't own, the beers they don't own. That's why when you go in H-E-B and you see people stocking up the aisles, those are like the Budweiser guy is stocking Budweiser. Coke guy is stocking Coke. Bread Gal is stocking, Buttercrust. So they don't actually own that. It's on consignment. So they don't have the rights to it, so it can't be part of their inventory, right? So I could go to the H-E-B warehouse and look around and say, oh yeah, there's a bunch of Cokes here that it exists. But do they have the rights? Nope. So that shouldn't be on the balance sheet. Valuation or allocations. Are they properly valued, right? Well, if it exists, I went to the warehouse and I saw a bunch of vehicles in the warehouse. Yes, they showed me the car titles, so I know they own those vehicles. What's the valuation? Well, they paid $10,000 per vehicle. There's 10 vehicles. That's $100,000 valuation. But wait, is it? When they paid $10,000 were those 2013 models, and now here it is 2016. They're not worth as much anymore, right? So I have to think about that in terms of financial. So for every account, you go through and you think about these assertions. Here's the income statement. Occurrence, right? Looking at sales. Did the transactions that make up this sales figure really occur? Because sometimes people fake sales. Hell, South did it. Tons of sales that did not actually occur. They faked the revenue. So this number consists of transactions that did not really occur. Completeness. Are all the expenses included? So certainly it would be nice to not put some expenses in, right? Presentation. Are they understandable? Has everything been disclosed, right? So that's how the assertions relate to the financial statements. As auditors, yes, we're auditing the financial statements, but there's all these underlying assertions that we need to understand and test for. We're actually going to test for these. And that's a lot of what we're learning is what's the risks to the existence. How do we test for that, right? All right. So, all right. So, continuing on with that. Okay. And so a lot of what we're going to be doing in this class is talking about what's the risk that cash doesn't exist. What's the control for that? Well, there's financial statement, there's bank statements that come from the bank, and then somebody in the accounting department balances the cash general ledger, compares it to the bank statement. That's how we know it exists. Great, I need to go test that. Are they really doing that, right? So we're going to learn about these risks, we're going to learn about these tests. That's what we're going to learn. All right. Now, as we do our audits, this is the next main thing. As we do our audits, we are constantly thinking about how will I prove that? All right? How will I prove existence? Okay, so I see this bank statement that says there's that much money. How do I know it really came from the bank? Did I get it myself? Or is somebody showing me this, right? So always thinking, always questioning, making sure you've got it. Inquiry's never enough. Get sufficient corroborative evidence, right? So if I go to the lady who balances the cash GL and I say, hey, did you balance the cash GL this month? Yep. Here's my reconciliation, see? And I'd go, well, I've got your word for it. You've shown me your reconciliation, but I need to see the bank statement and re-reconcile it myself. So that's professional skepticism. You keep asking, get the answers, then verify the answers. You must always be skeptical because this conflict of interest always exists. Management wants to put the company in the best possible light. Auditors want to make sure that the financial statements are fair and accurate. There's a bit of tension here, right? So always question, always ask. So that's what we're learning is what questions to ask. Basically, how to display my skepticism. How do I know? If I'm auditing financial statements and I'm looking at an account balance, how do I know that exists? How do I know they have the rights? How do I know the value is true? How do I know that transaction occurred? And I keep asking the question. So that's what auditing is about. Getting the financial statements, asking the right questions, getting the answers. All right, so that's chapter 1. We're going to do some in-class exercises. So what I'd like for you to do for Monday, the 25th, right, if you check on your syllabus, you'll see I think we're going to have both a quiz and, let me just double check here real quick. I think we're going to have a quiz on chapter 1 and a class activity on chapter 1. So if you come out here, you'll see there's some practice quizzes. So go and work on those practice quizzes from chapter 1. Go to in-class activities, and you will see that our in-class activity for Monday is going to be problem 1.59 from page 37. I'm not saying you have to work it in advance. You might want to look at it. We'll probably have a little group talk. Maybe we'll split into separate groups and take different sides or something. But that's what we're going to do in class. Take a quiz on chapter 1. So study the old quizzes, study the chapter. Study the end of the chapter multiple choice questions, right? Because the answers are out here, right? Go to the end of the chapter, practice those questions. Here's the answers so you can see how you're doing. And be ready to have a little class quiz and a little class activity. And I will see you Monday, and we'll have a good time.